Zac, Orchard. Yeah, you're Matt's colleague. So you've got a big overview of the sector, really. When institutions and investors start accessing the whole asset class, what's the kind of information you're having to give them? What kind of granularity of information are you having to provide? How far does it go down? Are institutions realistically getting out credit models and then, as we heard earlier, trying to second guess them against the platform's credit models? And how far are they going down?
I think that it depends on the platform. So you've got platforms that fall into two camps. Quantitative, who have performance history, and in that case you can create credit models and do that type of analysis, and then more emerging platforms where you need to qualitatively look at who their team is, what their underwriting performance predicts, and kind of how their operations are run. So we can help them on both sides.
And do you think it's realistic that institutions can basically provide a better data-driven model than the platforms? Or should they fundamentally just take those numbers on trust?
I think if you're an institution that thinks that you can, then you can certainly try. If the data is made available, then there's room for those types of models to exist in the space, in our opinion.
I'm interested to hear both Bill and Ramit's view on this, because in terms of you both work with small businesses, and we heard a bit earlier on that small businesses are probably a bit riskier, I think that'd be the perception at least, than consumer loans. I mean, you could get your FICO score out and look at the scores and then measure them back against returns, and you get a sense of stuff, okay? But in small businesses, we heard earlier, it's quite difficult to do that analysis. Is that true? Can you really get granularity? Could you really try and get a better idea? Why don't we start with you, Bill, and I'll get your view, Ramit.
Yeah, absolutely. We can see that the small business is really like an asset class, if you will.
Yeah.
And it's a misunderstood one. I think we've all heard about the credit gap in the United States.
Yeah.
And it exists elsewhere as well. And so what we see is it's just really been a misunderstood asset class. The default rates are far less than high-yield bonds through a cycle.
I mean, are they?
For example.
Yeah. I mean, are they? I mean, you could give some sense about, through a cycle, how that would play out.
Yeah, I mean, the Wall Street Journal had an article in September, and they showed that 15% default rate for high-yield, non-investment grade bond issuers in 2009. The reality was small business, now it depends on what sector of small business you're playing in, but small business as an asset class was about 7%.
7.
Okay? And if you look at those really small companies, it didn't get above 9 in 2009. So it's far less risky, and I just think it's just been a misunderstood, and that's part of the reason why credit has been held back to small business.
Yeah, Ramit, would you agree with that? I mean, is it it sounds like it's much less risky than even I thought it would be. I thought it would be double digits.
So we've been tracking the small business lending data on our platform as well. And what we've seen is that for bank loans, over the last 6 or 7 years we have been in existence, the default rates have been less than 2% for SB and bank loans, And it typically depends on how you source your customers, where they're coming from, and what kind of data you can get on them. But I would definitely agree with Bill that the default rate is much lower compared to some other asset classes.
So let's just explore this in a little bit more detail. So you're an institutional investor. You want to put money to work in the sector. So what you're saying, though, is that there is an advantage to be gained by using the underlying credit metrics that you guys are producing and analysing. Looking, is there money to be made by working out what sectors to prioritise? Is there money to be made by working out geographies? Do you see what I'm getting at in a sense? So I'm trying to zero on that alpha. Where is it? I mean, where do you start?
Okay, well, I'm sorry. Okay, well,
Well, you all join in a second.
Yeah, look at. If you look at, there's different volatilities of risk by industry or by geo. So Atlanta, for some reason, the Atlanta district in the United States has a far higher default rate than Minneapolis. I think it's just the nature of these local economies. Farmers have had a much better performance than trucking companies. Printing companies are getting taken out by digital media. And so there's all these dynamics that are going on underneath. And I think there are plays there to play the industry sectors, play the geographies, and take advantage. Because what we see banks do is just kind of one size fits all.
Yeah.
They just kind of assess it all as one kind of risk. And the reality is the range of risk is much different. Printers in 2009 had a 13 or 12 to 13% default rate versus farm producers the basic kind of corn grain farm producers had about I think it was like a 3% default rate. That's far different, and you can make money in that market.
James, you're nodding. I mean, are you finding? Tell us a bit about your platform. Are you finding that if that granularity, you could really make a kind of an impressive return over, say, benchmark yields?
I'm definitely seeing the granularity. I think if you look at investment in the major consumer-based platforms, the rating is one level of granularity you can look at. But if you dig a little bit deeper and you look at geocodes and you correlate that with a lot of the big data sources that we find out there and look at economic cycles, that, by the way, is different in each geocode, you can find a lot of, you can find additional information that adds to alpha.
But I suppose it poses the obvious question for the national banks, the big guys who operate across the states, not the community banks. But presumably they've got this data, so why aren't they being more granular in their lending decisions and thus taking advantage of it? Or are they, and they're actually skimming off the really good customers at the top, leaving not much left for alternative finance?
I do think on some level, there's temptation to do that, but there's also for a lot of banks, there's a concern about redlining in the U.S. Obviously, that's an issue.
It's even in Europe as well.
Right. And for investors, the argument is a little bit different. As an investor, you're providing a asset allocation decision. You're looking at different buckets, different rating granularity, which, like geocode, has different economic cycles and is linked to different economic indicators. So I think part of the job as a manager, I think Peter Sterling from Overland earlier mentioned that it is kind of like an asset allocation decision.
Yeah.
You're not trying to cherry pick each individual loan, but you want to know which sector or which bucket is going to do better than others.
Ramit, again, do you concur with this? I mean, so are you seeing? So if you've got this granularity that you can deploy, should investors be approaching this space and going, right? Well, I'm only going to invest in, I don't know, Atlanta-based digital media companies and agricultural supply equipment versus, Minnesotan-based, whatever it is. I mean, should they be going down to that level?
So what we have done on our platform is that we have created a biz analyzer score, which is capturing, all these attributes, the geocode, and, the industry type. And we are sort of providing the risk rating to the institutional investors and telling them that on a individual loan level, where we see more defaults, which industries, and I agree with Bill, like trucking would be a higher default industry, even in alternative financing as well and bank financing as well. So we are providing, even on a geographical level, let's say in Southern California or in Florida, we are seeing more defaults, So that information is available to institutional investors.
I think the main thing is that this space has the flexibility for investors who, if they want to cherry pick on platforms and that fits in with their strategy, they can do it. Alternatively, if they want to take a platform portfolio allocation approach, they can do that as well.
James, you can say.
I think there's always room for investors to look at a big data approach and to figure out, not necessarily cherry picking loans, but to understand what are some of the trends and some of the data indicators that can impact the performance of the loan. Ramit, I think what you guys are doing with weather data is extremely interesting, right? And we're doing a lot of work with local unemployment data down to the county level, but also taking a bigger step back and trying to see if there are certain groupings that we can look at beyond just the ratings. There's a lot of tremendously interesting opportunities.
I'm just curious. Talk me through the weather opportunity. Apart from the fact that I imagine Atlanta's a little bit warmer than...
So what I would say is that, last year was a very harsh winter, so we saw that a lot of businesses, in the Midwest and in the Northeast were very adversely impacted by the winter, and, there was a higher default rate or they couldn't make the payments for their financing during that period, So we have built in that data into our scoring model as well, because if you look at yogurt shops or, hotels or hospitality industry, they suffered the brunt of the weather, So we are including that data as well in the scoring models for institutional investors.
And again, with all of you, is it expensive to get access to this kind of information? I mean, if you're an institution, is it a bit like Bloomberg? Does it cost me $20,000, $10,000 every screen in my office? Is it really expensive, or is it actually quite cost effective for asset managers to use it?
Yeah, we say you don't go to a discount brain surgeon, you go to the best. So you'll want good information to make good decisions. So.
Right. I think we in English we have a posh up market at supermarket Waitrose who do something that's roughly the same thing.
Just like being a brain surgeon, there are textbooks out there telling you how to do it, but you really don't want to do it on your own. A lot of it is about applying the right technique at the right time, and having the right team to do that kind of evaluation is very important.
Okay, well, I'm going to ask you a cheeky question, each of you now. So you say that if you use granularity of data, you can effectively, from an asset allocator's point of view, eke out maybe a return over benchmark. So I'm guessing is what you're saying. Where's the sweet spot? Where are the sweet spots? Where should I be deploying money at the moment? I mean, presumably I'd have to pay large amounts of money to get access to. But James, where do you think is the real sweet spot at the moment?
I think the small business is extremely interesting. I mean, obviously we look at a lot of.
What do you mean by small businesses? Under $250,000 loans?
I would say maybe $250,000 to $500,000.
Okay.
But if you look at consumers, it's probably the close to near prime, but not quite near prime. If you look at some of the delinquency data, there's some slightly worrying trend. Like, I think everybody sees those big charts with delinquency going down with the major platforms, and that's certainly been good. But one thing to keep noticing is that doesn't apply uniformly to all the rating buckets. On some of the lower ratings, you definitely see some worrying trends.
Bill?
Yeah. We saw Gary's chart about how much activity occurs for the really small loans. We see that banks are really going up market, $400,000, $500,000 transactions, and so they're walking away from those small loans. So there's a big opportunity in those small loan categories. There's opportunities across the credit spectrum. I mean, there's prime borrowers that are borrowing money from these folks here. We see that in the data. And these prime borrowers have default rates of under 0.5%. And so they want quick access to capital. The story was told earlier. So there's that kind of opportunity. There's an opportunity with subprime borrowers as well. And so it's across the credit strata, and it's to those really smaller loans, $1 million or less, where there's some pretty nice yield. Where else can you get these kind of double-digit yields right now?
All right.
I would agree with Bill, that in prime and near prime in small business lending, there's a huge opportunity. The borrowers don't want to wait for banks. The banks are still not moving that quickly. And, the default rates are extremely low. And what we are seeing on our platform is that banks are seeing the repayment data for institutional or alternative loans and then refinancing those customers. Because even if they're not able to move quickly enough, the borrowers are using that as a bridge to meet their immediate working capital needs and then graduate to a bank loan.
Zac?
I think ultimately the answer depends on what kind of investor you are, but some interesting strategies that we've seen lately have been applying leverage to the higher rated consumer loans.
Okay.
We've also seen an emergence of asset-backed small business platforms, specifically in construction, and real estate is starting to gain a lot of traction as well.
And if you pick these particular sweet spots, are you likely to see 1%, 2%, 3% more than a kind of benchmark return? I mean, give me some quantum of, what you can get by that asset allocation.
It all depends. We have investors, on our platform getting anywhere from 6% up to 18%.
Okay, big old range. Okay, we've got a busy old session before lunch, so I'm going to call it there. And I think I'll be coming and chat to these guys myself a bit after and finding out a little bit more about where I should be borrowing. But in the meantime, say thank you very much, and we're going to move on to our next panel. Thank you, gentlemen. Thank you.